In 2026, the average person will spend more on insurance premiums than they will on their own retirement contributions. We have been sold a vision of the world where every possible catastrophe can be neutralized for a small monthly fee. The system tells you that being fully covered is the ultimate sign of adult responsibility, that if you aren't insured for your life, your health, your car, your phone, your pet, and your travel, you are a reckless gambler. They are lying to you. The truth is that the insurance industry is a massive negative-sum game designed to harvest your fear equity and transfer it to the balance sheets of the largest institutional buildings in the world. Today, I am going to prove to you with brutal, cold-blooded arithmetic that insurance is not a safety net, it is a structural leak in your wealth-building engine. I am going to show you why playing it safe is mathematically ensuring your long-term failure and how the system uses the risk aversion trap to make sure your capital never reaches the critical mass it needs to escape the treadmill. You aren't buying peace of mind, you are renting a false sense of security at a 300% markup. The reason you fell for this trap is rooted in a psychological phenomenon known as probability neglect combined with loss aversion. Humans are biologically wired to over-index on low-probability, high-impact events. Your brain doesn't see a 0.1% chance of a disaster. It sees the disaster itself playing on a loop in your imagination. The insurance industry exploits this by framing their products as a shield against the worst-case scenario. This is fear marketing at its most refined. You have been validated by a society that views the payment of premiums as a virtuous act of protection for your family. But the system was designed by actuaries, people whose entire job is to ensure that on average you will always pay significantly more than you ever get back. For the insurance company to stay in business, you must lose money. By keeping you focused on the 1 in a million catastrophe, the system ensures that you ignore the certain 100% probability catastrophe of having your net worth slowly bled dry by monthly protection fees. It is not your fault you feel the need to be covered. You are fighting a multi-generational conditioning campaign designed to make you fear the very volatility that creates wealth. Let's look at the hidden math that the friendly insurance agents conveniently omit. We are going to look at scenario A, the fully covered soldier. We will call him Tobi. Tobi is 30 years old and earns $80,000 a year. He is responsible. He pays $200 a month for a high-tier health plan with a low deductible, $150 for comprehensive car insurance, $50 for a life insurance policy he doesn't fully understand, $40 for gadget and appliance protection, and $30 for pet insurance. Total monthly peace of mind cost, $470. But let's look at the actuarial theft math. Over the next 30 years, Tobi will pay $169,000 in premiums. Because of inflation and premium hikes, that number will likely be closer to $250,000. Tobi will use his insurance for minor claims, a cracked screen, a fender bender, getting back maybe $30,000 in total value. Tobi thinks he's lucky he had the coverage. In reality, Tobi paid a fear tax of $220,000. If Tobi had taken that $470 a month and put it into a boring index fund, he would be sitting on nearly $600,000 by age 60. Tobi sacrificed $600,000 of actual liquid security for a piece of paper that promised to protect him from things that mostly never happened. Tobi is insured, but he is $600,000 poorer, making him objectively less safe in the face of a real economic collapse. Now, let's look at scenario B, the self-insured truth. This is Liquid Larry. Larry understands that insurance companies are just giant piles of cash that bet against you. Larry decides to only insure against total ruin. He takes the highest possible deductible on his car and health insurance, slashing his premiums by 60%. He cancels the pet, phone, and appliance insurance entirely. Larry's monthly premium cost is only $180. He takes the $290 he's saved and puts it into a dedicated self-insurance fund, a high-yield account that he owns and controls. In 10 years, Larry has $40,000 in his own pocket. If his dog gets sick or his phone breaks, Larry pays cash. He doesn't file a claim, he doesn't wait for an adjuster, he doesn't see his premiums rise. Most importantly, if Larry doesn't have a disaster, he keeps the money. Tobi's premiums are gone forever, fueling the CEO's private jet. Larry's premiums for his own equity. Larry has realized that the best insurance in the world is a massive pile of cash, not a contract with a corporation that is incentivized to deny your claims. Consider the real-life case of Tobi. Tobi is 45 and has paid for extended warranties on every electronic device he has ever owned. In 2026, Tobi's laptop screen glitches. He spends 3 hours on the phone with the insurance provider, only to be told that wear and tear isn't covered under his specific plan. This is the fine print gap. Insurance is the only product where you pay up front for a service that the provider is legally and financially motivated to not provide. Research shows that for every dollar paid into consumer insurance, phones, appliances, and travel, the payout is less than 20 cents. The other 80 cents go to marketing, overhead, and profit. Tobi is participating in a wealth transfer where he is the donor. He has been tricked into thinking he is transferring risk when he is actually just prepaying for a loss at a 500% premium. The reality check is this: insurance is a mathematical certainty of loss for the consumer. In 2026, as the cost of living skyrockets, the math of fear is being used to keep you from building the only thing that actually protects you: liquidity. To survive, you must perform a risk audit and shift to a defensive equity strategy. First, identify true catastrophe versus maintenance costs. A true catastrophe is your house burning down or a $1 million lawsuit. Insure those. A maintenance cost is a broken phone, a vet bill, or a car repair. These are not risks, they are inevitable life events. Stop using insurance to pay for things you can afford to pay for yourself. Second, maximize the deductible. The insurance company wants you to have a low deductible because it allows them to charge you a massive premium for a small amount of risk. By raising your deductible to the maximum, you are taking back the most profitable part of the math for yourself. Third, build a fortress of liquidity. Your emergency fund is your primary insurance policy. Once you have $50,000 in cash, you are self-insured against 95% of life's problems. You no longer need to pay the fear tax. Fourth, realize that peace of mind is a marketing slogan, not a financial metric. Real peace of mind comes from having a balance sheet that can withstand a hit, not from having a phone number to a claims adjuster who will try to lowball you. The insurance scam is effective because it exploits your love for your family to make you financially fragile. It turns your fear of the future into a recurring revenue stream for the elite. You are being sold the dream of total safety, so you don't notice the reality of your slow-motion bankruptcy. Your premiums are not an investment, they are a cost of being afraid. If you want to be truly free, you have to be willing to carry the risk of the small things so you can own the rewards of the big things. The path to real wealth isn't paved with premium coverage, it's paved with the courage to trust your own bank account more than a corporate promise. But the insurance trap is just one part of the negative-sum economy. The same institutions that want you to insure your life are the ones who have convinced you that the house is your greatest investment, while they trap you in a 30-year mortgage that ensures they own your labor for the next 3 decades. If you think the math of fear is bad, wait until you see the math on the homeowner's illusion that is currently liquidating the net worth of the modern worker. Stop renting your safety. Start owning your risk. Because in a system built on fear, the only way to win is to be your own bank.